Well, what a start it has been to financial year 2023. We have one of the biggest marriage in the financial services sector and the HDFC group, amongst which, HDFC Limited will merge along with its two subsidiaries in HDFC Bank. Now, the share swap ratio that has been worked out is that for every 25 shares that you hold in HDFC Limited, you will be given 42 shares of HDFC Bank. So, this is a good swap ratio given the fact that the overall shareholding of HDFC Limited in HDFC Bank will increase to about 41%, and post that entire 100% holding will be by the retail holders in the bank. So this is a good opportunity for FPI as well. FPI means foreign portfolio investors, given the fact that post this merger you'll have the foreign holding coming down to about 65 to 66% in the bank, which then gives you an opportunity or a window of opportunity of about 7% to come back to 74% level. So this is a good opportunity for investors who reside outside India to participate in the growth story that HDFC Bank has to offer. Now, there will be a management continuity given the fact that KK Mistry is already 69 years old by the time this deal gets concluded. So there is a threshold of 70-year age limit for financial services sector. Hence, we'll have SASHIDHAR JAGDISHAN, who is the current MD and CEO of HDFC Bank, who will continue to remain at the helm of running HDFC Bank even post the merger. So post both the entities, by Q2 or Q3 of FY24, when this merger happens, you will see a continuity in the management, and there won't be any management change on account of the fact that Mr. Jagdishan will be running at the helm of running the bank. Apart from that, HDFC Bank has multiple opportunities given the fact that, they'll be able to expand their product portfolio or have even cross-selling opportunities in segments like insurance, wherein, life insurance and general insurance they'll be able to offer. On the other hand, HDFC Limited will get access to cheaper cost of funds. Now, remember that, HDFC Bank has access to cheaper cost of funds like current account and savings accounts, which are, current account is at 0%, saving accounts is at 3 to 4%, which is way cheaper than other kind of loans that that banks do take in terms of deposits or borrowings, which comes in at around 5 to 7% levels. So HDFC Limited will benefit from cheaper access, from access to cheaper cost of funds. Deal is also EPS accretive for HDFC Bank, given that the merged entity, the number of shares will reduce. With the current profitability, this will mean that it is an EPS accretive deal for shareholders. Now, let's go into the maths, what this will benefit in terms of market share. So HDFC Bank, post this merger, will see a rise of 450 basis point in their market share. So from current level of 10.9%, the market share will increase to 15% or even more post the merger. So pre-merger, HDFC Bank's book, if you take a look, it is at around 12 to 13 lakh crore, which is 56% bigger than ICICI Bank. Now, post the merger, HDFC Bank's loan growth or loan book will be around close to 18 lakh crore, which will be 2.2 times from the next, peer, that is ICICI Bank. So HDFC Bank's book will be close to 18 lakh crore when compared to ICICI Bank's book of a little more than 8 lakh crore. So by far, you will have HDFC Bank as the largest private bank in India, and the gap between its loan book and SBI's loan book will actually reduce. SBI's loan book is about 26.6 lakh crore. So it still continues to remain the largest bank in India, given the fact that its loan book is around 27 lakh crore. However, with this merger, HDFC Bank will have a massive gain in its market share, and henceforth, as and when it grows, the gap may reduce in terms of market share to SBI.